Again, my name is Robbie. I'm the CEO and founder of Brightflow AI. Thank you guys for your time. I know time is really um, a precious thing nowadays, and you guys could be doing a lot of things. So I appreciate taking time to join us today. Um, I wanted to just start by kind of telling who we are. Brightflow AI is basically a software platform. We're building a software platform that integrates with all your financial data. The idea is to create a really simple, comprehensive, automated platform to help everyday business owners kind of go through their financial decision-making processes. We think that information is typically where arbitrage is built. And so the people that have information and that can understand things like their finances are the ones that typically tend to win in the business world. And we want to make that information more prevalent to everybody else. And so we'll get going. A little bit about myself and Matt. We started Brightflow about a little under a year ago. Prior to that, I was a CFO of a company called Flex Company, which is still one of our customers. Prior to that, I started a company called Sweetness. I was at Capital One and did my MBA at Berkeley, but raised about $40+ million from equity and financing, whether it's through credit financing or equity investments into my own business or into Brightflow. Matt here is our head of product. He also has a finance background. He's a CFA, also a Berkeley MBA. Started his career in corporate finance and private equity, and kind of just been working in investing and product management since. So what we're gonna do is basically I'm gonna give a little bit of a background into the current market environment. Hopefully it gives you a little bit of context into why we think this is an important topic and helps in your businesses in some way or another. And Matt will delve into really tactical things that we can do and scenarios that might help. So the goal here is just to give you guys some, free education, provide some insights that we've heard and people have told us, and hopefully it helps in some way and answer any questions at the end. As we know, the last 3-4 months the world is pretty much upended, and it's been upended pretty drastically by something very small. And the pandemic has chipped not only consumer behavior but also the macroeconomic trend, market as a whole. It's changed how we view business, how we view meetings this way, how we do sales pitches, and something small like this definitely has creates shocks. And the thing that's interesting that our entire system, especially when it comes down to business systems, are really so interconnected. We have household purchases, your consumers who you sell to, businesses you guys might work with, have changed. People, not only just the inputs but the outputs, how people pay, getting money faster, paying taxes, everything has just kind of got upended. And it's kind of crazy to think about it, that something so small has caused such an entire shock to the system, but it has been that way. But the one thing we've seen recently, and I'm a little bit of an optimist, and so what we've seen is that there's been some positive signs, specifically after the initial shock. So a lot of times in markets you have rapid volatility and then stabilization. And the stabilization really coming around consumer spend, which is what we at Brightflow deal a lot with, is CPG companies, consumer product goods, e-commerce brands, and we'll be expanding more. But initially, the consumer spend is a big part of purchase behavior. And so that we've seen that change and starting to stabilize. But knowing how long it takes to get to baseline, which is where we were in March, those numbers are not out there. No one really has a clear idea, and this can also rapidly change as infection rates can go higher, and so there's just a lot of things, uncertainty, but there is positive trend signs. And obviously some industries fare better than the other, and this is just more to give you guys some context. But fine dining, for example, is not going to recover because you can't go into restaurants anymore, and capacity is naturally 50% lower. Places like retail, apparel makes sense. You're not dressing up as much to go to. I put on a shirt for the first time, and that's not a regular t-shirt for a long time. But things like office supplies and workout equipment, at-home care, those type of industries have really done really well and weathered the storm. A couple of our customers have done very well, basically because that their industries are more of a must-have rather than a nice-to-have. And I think that's where the differentiation happens. So when we think about like this market of uncertainty, one thing I wanted to share with you guys is this research that came out in Forbes on, talking to about 400 or so CFOs of what's the most important thing in these moments of uncertainty. And across the board, the first thing is like, when is it going to get back to normal? But even that idea of timing is really important when it comes down to the survivability of your business, because it really comes down to, can your business survive? And the second thing is cash flow. So those two go hand in hand. How do we get back to the time so I can reinvest my business? I don't have to do this stuff like cutting costs or, be very, cautious, and we be able to grow again. As business owners, the number one thing we want is growth. It is our lifeline. It is why we do what we do. But the other thing that's like right there near, like when things are going to get better, is really our cash flow. And if the Fortune 500 company CFOs are talking about it, the thing is that small businesses should be dreaming about it, and they should be, everything in their business should be the number one reason. And we wake up every day and should be thinking about cash flow, is because the number one reason businesses fail is not that the people run out of cash. It's not a venture-backed, Silicon Valley-backed company that has a certain amount of capital in there. It's people that's their lifeline, and it's it's on my lifeline. And so 82% of businesses fail is because of the timing of cash. It's knowing when payables go out and when receivables come in, and it's the most important metric. And so, this is an important thing that we want to grasp, is that the best way to tackle any system and anything is actually cash management. But the issue is that unlike the Fortune 500, who have access to financial teams, investment bankers, banks that can pick up their phone calls right away because they have, tons of money on their balance sheets. Small businesses don't have that, as well as it's really not as simple. Like revenue you get in, you see your sales going up or down, but your cash balance doesn't match it. It's because timing of cash is really hard concept to understand. It's really something that you learn. You're fortunate enough to learn it through experience. It's not that difficult. It's it's money in, money out. But when you get money in and when you send money out is the most important lifeline of a business. And I think that's the important thing. And so we're, making sense of cash flow is tough. And so that's what we're trying to do here. And this little background, I'm trying to, what I want to do is show you guys that this is actually a very, very important topic, and it allows us to, sift through the noise. Warren Buffett looks at companies. He doesn't look at companies that on their profit and loss. He looks at companies on how well they produce cash and how well they collect cash, working capital. And so we want to demystify this stuff for you guys and hopefully provide some value in kind of all this noise you guys have. And if you think about demystifying it, if you break it down to, what I call the least common denominator, the simplest form, which is cash, it becomes demystified. But the problem is again, we do things kind of backwards sometimes, especially in things like accounting. So the first thing to remember when you look at your QuickBooks or your Xero or any type of Excel model you guys have or your accountants use, is that the way that we do our P&L and the accounting P&L is not what your cash is. So you're trying to be profitable, which is great. But profitability on marketing expenses and revenue you get is not really the best way to survive your business. And the reason why is everything is based on accrual-based accounting. You can do cash accounting, but cash accounting is not considered GAAP or generally acceptable accounting principles, which is what you do for taxes. So P&Ls are very important. It's what accountants use. It's what gives you your taxes. It gives you kind of the health, like the longevity of a business over the long term, because you recognize revenue. But it's really hard because it doesn't really give you the cash. One simple example is if you pay money on credit card, even if you expense it right now, that payment is not due for 30 days from now. So when that bill comes due, if that money's not in the bank, that's when it hits. And that's just the simplest way of thinking about cash versus accrual accounting. And so when we think about how we help our customers out is in a very similar way. We look at cash first, not P&L. It's the cash flow statement that's important. And so to manage your business through these turbulent time, the most important thing is around managing cash and not managing your P&L like we talked about. So this is kind of that simple way to think about it. Here's some things that we've done in research and we found even in our own experiences, and what I give to my CEOs when I was a CEO or when I'm a CFO. One thing is leverage timing of cash. So leverage non-cash tools. One really easy way someone told me, I think 5-6 years ago, was MX Plum. If you look MX Plum, why would you want to look at MX Plum? Is because it has a 60-day payable. They give you a little bit of bonus if you pay ahead of time in 30 days, but you don't have any problem with paying 60 days. So if you do Google marketing, you can use your credit card. And even if you expense it now and you're purchasing, you're basically marketing to get direct acquisition, you don't have to pay that credit card bill for 60 days. And that pushing the can down the road allows you to invest in your business now. And so leverage the timing of cash. Negotiate with your suppliers. Right now in this time, obviously suppliers are really tough. Even the smallest things, like we did this in 2 of our customers, where we went in and took even the small, $2,000 a month, or like $1,000 or $50 a month kind of contracts you have. And we went back and said, look, I'm not going to be able to do something until we are in a better visibility. And people are okay with that because they're dealing with the same stuff. So, it's kind of bad because you want to collect, your job is to collect cash as much as you can and collect that AR. On the other side, you want to be able to push the AP as much as you can. So leverage timing of cash. The second thing is to manage the business through this is trim the fat. And so you never want to do a massive ratchet job on your business. What you really want to do is curb non-essential spending. So new equipment, let's put it back. New laptops, let's extend it. Any perks, that you have in payroll, let's manage that over the short term. Your employees will understand as they get, jobs. And if you obviously, you want to be able to manage inventory more closely. The other thing is optimize marketing not for growth, but for margin expansion. So what we find in the CPG space is if you shut down marketing, your entire business goes in. So it has a ripple effect. If someone doesn't come in, your organic traffic can not go down. People coming to your Shopify storefronts reduce. And so just shutting everything down and then turning it back on is really tough. And even Google's algorithms take time to boot back up. And so they need the data. And so shutting on and off is just not a good thing to do. And so what you want to do is manage everything, make it as trimmed down as you possibly can. And kind of focus on that cash flow to reinvest in your business and kind of doing more tests and more, being much more thoughtful on it. So leverage timing, trim fat, find alternative source of cash. Easier said than done, obviously. But the one thing that's happened in this world is that there's a lot more access digitally that you used to have before. One great example is Circle Up, is a company that does AR factoring for retail, but they now don't take your historical, P&L financials. They just they look at your Shopify revenue stream and they just give you based off of live data. Clearbank and gives you offerings on your marketing spend, and they look at historical 12-month spend on your real-time data that's coming in from Google. So they're taking your data. It's not that you have to go and do a lot of work. There's 60 what they call neobanks, which are digital banks. SoFi has become one. It used to be a financing arm for business schools or schools in general to refinance your student loans. And so SoFi has now built an entire banking structure around it where and it's easier to apply, and it's not really you don't need to get a colonoscopy as you would do in a traditional bank. And so as those mechanisms change, you can find alternatives to cash use. So what you're doing is pushing things down the road. You're trimming fat. You're finding alternatives. It doesn't have to be a lot. You're not. These are low interest kind of things. You guys have built probably a lot of access. Obviously, PPP, take advantage of it, but those are ways that you can extend your business in these times. Is being flexible, being open, trying to figure out what to do, looking at policies on payables, and all you're trying to do is really survive. And then the last thing is when I say survive as well as reinvest, that sounds counterintuitive in a turbulent market, especially when it comes down to when I just gave 82% of business failed, that numerical number. But the reason why it's so important to invest internally is that even in this time, you want to be able to take little tests and you want to make your business a little bit more efficient. And it's an opportunity to make it efficient. So rather than sitting back and talking like this is the world that's going to happen, is you change your mindset of what things can I extract out of my business. So, something like, our product is not going to be, people use large products. Ours is going to be very, very small in terms of price per, but that's because we're like a SaaS business. So instead of big licenses, you do small SaaS products, which are $10 a month, $20 a month. E-procurement, clean up the books, invest in simple market strategies, keep focusing on product, try to see if there's flexibility in your supply chain. Like those investing internally doesn't need to be capital. It can also be time. And that's where you really want to spend your time. So to manage business, and what most CFOs then try to do is they assess their business, they look at scenarios, they see the landscape, they try to maximize timing of cash. And it's kind of what the financial instruments are. It's what the big Goldman Sachs type of banks tend to do a lot of, is get access to cash, and they trim fat, and they don't stop thinking about their business and investing into it. And so these are really, I think, some of the ways to do that. And so when you think about financial management, and this is the last slide before we jump into Matt's section, which will really be about, here are some specific things that you can do in terms of marketing, inventory. But I want you to really, like, this is more of a step back. You have to actively monitor your cash flow. So you have to get out of the fact that, hey, I have, you have to be able to monitor AR/AP. You have to be prudent. So you have to be very good at it. You have to make it timely. You have to make it accurate information. You have to be on your accountants. Accountants' number one job is to sit there and close your books. But timing of closing books can be certain amount of days after a month closes, and you don't close your books every week. And so you have to be there and to be aware of it. And so tools like ourselves, or your own Excels, or whatever it is an easy way to do it, or just hounding your accountants. Build truthful scenarios. When I say truthful, don't kid yourself. Like, just take conservative looks. And take various ways of doing it. So if I'm conservative, what does it look like? If I'm a little bit more aggressive, what does that look like in terms of investment now and cash out right now? And truth is tough, because it's hard to look at, your business is your own baby, and my business are my own baby in that same regard. And the last thing is, like, if you haven't done it, I know, it's hard for me to financially manage even my own finances. Then you have to think about a business's, your own business's finances. So just make sure you enforce budgets, establish it, and just, if you haven't. So those are the kind of things that I think, from a perspective of ways you can leverage it, cash, and kind of the important parts of financial management, that it becomes important. So next we'll just head over to Matt, who will go into the next section. And really, it's more about the actual scenarios around it. All right, Matt, go for
it. Great. Great. So Robbie, can you guys hear me?
Yeah.
Okay, great. Okay, so so welcome everyone. And so Robbie talked a little bit about COVID and some of the changing scenarios in the environment. I'm going to focus more on just cash flow and decision making. These things would apply in any time, but they're especially important now. And as a general rule, the way you want to analyze decisions is you kind of want to look, right at the outset, what will this cost, right? And what it will cost, that won't happen on day one, right? There's going to be a moment that cash is going to leave. So if you're doing a marketing campaign, you're going to have to preload some of those dollars beforehand, right? But if you're paying on credit card, then you won't have to pay for 30 days. So you kind of want to look at, like, what's the initial cost, the initial action, and then what is the domino effect that happens throughout the organization that impacts inflows and outflows. And we'll go through a couple examples of that in later slides. And then you just want to say, what is the ROI overall? So I've got all my costs going out that will typically happen at the start of the period, and I'm going to reap some benefits as time moves on. And you want to make sure that you're getting a holistic view of those outflows and inflows, so that you're making the right decision as far as a return on investment perspective. So we go to the next slide. Here are just a few of the examples. There's a lot of what-if scenarios that you're going to experience in your business. And there's actually only there's only so many that you encounter, and a couple of the really big buckets that you're gonna encounter are whether you should put in more marketing spend to try to retain more customers, get those customers earlier into your retention flow, whether you want to purchase more inventory, perhaps you're leading into a big holiday, or another headcount. Either this is a salesperson generating revenue, or it's another person to handle customer service, or those types of things. And then this last one is kind of a catch-all. There are fixed and variable factors. And when I say fixed and variable factors, and we'll touch on this later, fixed factors are factors that stay the same. You're going to pay $10,000 a month for this resource, period. Variable factors vary with sales, so shipping your product or sales bonuses, those types of things it's important to categorize those, because then you'll be able to know how they behave as your business grows. So you'll see on the next slide, I jump into one of these scenarios. So this is the marketing scenario, for example. And we're going to walk through the inflows and the outflows. So just across the top is basically this question: what if I spend 10K more on a particular marketing channel? Here is kind of the thought process that you should go through to say, is this a good investment? Outflows, you've got your kind of $10,000 outside of the marketing budget, and then you're going to have some additional costs, whether that's selling expenses or, like I said, shipping your product, that you're going to want to take into account. And you'll roll that down on the outflows portion of the investment. Then if you look at the inflows, it gets more complicated, because it's not like your customers just come. It's not like everyone converts and all your customers just come and spend money and then you retain them, right? So you need to kind of follow this path, this narrative of these marketing dollars through your business. You're going to have, let's say this $10,000 marketing budget gets you 100,000 impressions. You can look at a conversion rate either in your Google Analytics or calculate it through using Excel. And so here, just walking through this example, you've got a 5% conversion rate, or 5,000 people who order. You got an average order value, which you can calculate from your data, is $20, right? And I actually forgot to update this, but you can see that totals to a revenue amount. And then this retention spend is a really important number, because you're not just going to get revenue from the initial purchase that the customer makes. You're going to retain this customer, so they're going to come back to your website, hopefully through some email marketing that you're doing, and retention spend. So it's important to include. So a big takeaway here is it's important to include retention spend and the total lifetime value of the customer in your calculation, right? So you can kind of see from this quick exercise, this example, that you've got a $12,000 outflow, you've got a $24,000 inflow, and then your gross margin is basically what it costs you to buy these products. And so you can take your gross margin and apply it to your total inflows and get what your actually net profit would be. And that's really the number you want to compare to this $12,000 outflow. It's after your expenses, after your product expenses, where do you sit from a gross margin perspective, and how does that compare to your total outflow? So that one was a little more in depth. Inventory is another specific decision kind of point you're going to have to make. And here the question, what if I purchase more inventory to buffer heading into my busy season? We have a client right now who sells candles, and they have a very heavy December. And so they looked at this chart, which is basically talks about their cash cycle, and they say, hey, when we buy our inventory, it takes our supplier about 3 months to get us the inventory. And then in general, we hold the inventory around 2 or 3 months. And then it's 30 days, it's 20 or 30 days until the customer pays. So these guys decided that for December, they needed to start buying inventory in June because of the supplier lead time. So the stress here is that if you're looking to buy inventory for a busy season, look at your purchase lead time. How long before you sell a product do you need to order it from your supplier, so that you can then be prepared when that demand comes? But I would say also an additional factor to pay attention to here is your cash cycle, right? How long does it take for your dollar outflow to turn into an inflow? So it's very helpful to kind of time these out, and we're working on a product that helps kind of account for all of the timing of these cash flows. But basically, you want to use your cash cycle and your inventory cycle and work backwards from the date the customer buys to see when you need to order. And the third example was a headcount. And this, just quickly, you can, hiring another employee is a little bit of a different ballgame because it's fixed. It's really a fixed cost. If you hire another person, you're going to hire them for multiple months at a time. One way to shift those costs is to use, and I don't know if you guys have ever heard of a platform like Upwork or TopToll, and you can hire part-time people in a variety of functions. So if you needed someone to do a marketing campaign, you can go look at resumes on Upwork and hire them and try to shift some of those costs into the variable category. Okay, next slide. Okay, so this is, for those of you who've seen the Marvel movie, this is Doctor Strange, and he's here in this scene, he's using his time stone to like look forward at all the different outcomes of the potential coming conflict. And, you know, you're kind of looking forward at your forecast and it's this black hole. But if you use a model to kind of look at different alternatives, you can start to see, well, here are the realities that could potentially subsist, and it starts to give you some clarity into the different scenarios. So I think running these things is very important. However, right, you can't see everything. You don't know exactly what future is going to hit. So as you should, and go to the next slide, Robbie, always build in a buffer. Always build in a buffer. Don't run your model so that cash flow, you barely make it above $0 on your cash balance. You want to constantly build in buffers of maybe 10% on your cash balance so that you allow, or for example, a great example of this is you have a variable cost that you spend to a designer and you've budgeted it, but you always realize you're just 10% over. So these are things where you want to build in, you want to look at your expenses and build in these buffers to make sure that you have enough cash. So if you move to the next slide. So now we just talked about kind of these individual decisions. And now I wanted to back up and just talk about cash flow in general and how to look at your business from a cash flow perspective. And really there's, I break it up into kind of 3 sections. One is the inflows that you're getting from all of your revenue. 2, and that's coming from customers. 2 is the acquisition cost to acquire those customers, right? To directly acquire them. So this is marketing spend, Google ads, Facebook ads. And then 3 is the structural cost of your business. So you get a customer, you acquire them, they spend money, and then they kind of bounce against your organization, right? They hit your organization and it lights up like a nerve and springs to life, and certain costs aren't incurred and people spring into action as the fulfillment process initiates. So if you have the next slide, this is actually a screenshot of the product that we're working on, but it's a good way, it's a good analog to just think about how you should break up your inflows. Most of you probably have some type of e-commerce store set up on Shopify or Amazon, and then you potentially have an investor or you've got an influx of cash that's got cash into your bank account, and then there's any other manual or custom entries you could make. But this is kind of how you want to think about your inflows. You've got your e-commerce inflows, you've got any inflows of cash like from investments, or anything that's manual that you would enter in like from a retail or import from another source. So this next slide, right, basically takes a look at those inflows. And again, this is a product that we're developing, but you would want to create a spreadsheet like this, where essentially, and this is what you're seeing right here is the data in the table at the bottom is all of the inflows. And in the graph above, you can see the inflows and the outflows and how the cash moves. And this is for an actual client of ours that sells candles. And you can see across the, just under the inflows, I've got accrual revenue going right across the top. And I think the important point to make here is that the $254,000 I have circled for accrual revenue in February, that doesn't hit cash flow until March, right? And I have a graph that'll show you how to time things in the next couple slides. But oh, can you go back for one sec? Sorry, thanks. But this just kind of shows you how cash moves from period to period. And this is Bootstrap, or I'm sorry, one of our clients is a conglomerate, and we're working with one of their brands. And they took a look at this model and they said, holy shit, we're gonna run out of cash in November. So what are they doing right now? Right, they are going out and securing a revolver, right, to make sure that they have enough to purchase the inventory, because December is a huge month for them. January is a huge month for them. So going in, they have to just load up on inventory, and they need to make sure they have enough cash to do that. So they were our first client. They kind of put their data in our system. We outputted our prototype, and it's helping them make decisions about their business. So it's really important to kind of see these things lay out. And then afterwards, so we talked about inflows. Here are kind of the outflows piece, the next piece, the expected cost. This is another screenshot of just our onboarding flow. But as I mentioned in the slide before, I would think of these in two sections. One is customers are spending revenue. So what do I have to spend to get those customers? This is my marketing costs. And then once those customers are acquired, they interact with my organization. So what are those operating costs? So here, this gives you the opportunity to, upload automatically all of this data, right, to create a kind of sheet view. So you can go to the next slide. So here is similar to how we walked through with, you can integrate your inflows, and then you see a table-like interface where you can work with those inflows. Here are all your outflows laid out, right? So there's a lot to absorb on this page, because when you pull from QuickBooks and you pull from all the ad networks, you're pulling a lot of data, and there's a lot of line items to deal with. So if we just kind of start at the top, you've got outflows, right? And you've got Facebook and Google. These are your costs to acquire your customers, okay? And this days until cash simply just means that when you load your Facebook credits, you pay on credit card, and you have 30 days to pay that off, right? Same with Google, right? Same way if you purchase your inventory, right? You see your inventory cost below that 30 days. And you can see this points to kind of a little cash payments chart to the right. And you can see how as your days to pay increases, the percentage of revenue that will come inflow will change and get further and further out. So you can see the power of pushing some of your payable days out and collecting on invoices a little sooner. It has a major effect on the timing of cash flow. And then it's also, if you can go back, the one last point I'll make here is the way we've broken up costs here is you've got your marketing costs on top, your inventory costs in the center, and then everything else is in these last two lines, variable and fixed costs. And it's extremely important to break, because in QuickBooks, it doesn't say, hey, this is variable, hey, this is fixed. And when I say variable, I mean that the cost varies as revenue varies. So fixed cost, if revenue doubles, you still got one accountant. You're not gonna hire another one, right? But variable costs, if you have postage, because you got to send your product out, right, that's gonna increase. So you wanna go and bucket. You've got inventory, you've got marketing, and then you wanna go bucket all your other costs into variable or fixed, so that you can so they can tell how they move as revenue moves, and use those to forecast. And then if you want to know the cash impact, you've got to work in this time delay so that you can see when cash is hitting your books and if you have a shortfall. And again, these are concepts that we're putting together and thinking about a lot and getting in front of guys like people like you. And we're trying to create a solution for this so that you can create something like this in, a matter of minutes by just importing your data. So the next slide. So finally, it's the biggest, most important thing to remember is that 82% of businesses, they fail just because they're mismanaging cash flow. And cash timings is both inflows and outflows, right? So it is important to do the work to build a spreadsheet, to think, here's my revenue line item, here's the timing of that inflow, here's my cost of my suppliers, here's the timing that cash is going to go out the door. And really, it's very, very important to categorize what is fixed and what is variable, so that as you forecast forward, everything's going to kind of be based on what you think your revenue is going to be. And so it's really important to categorize, to do inflows and outflows, but then categorize what's fixed and what's variable. And then the last thing is, I would say, when you're thinking about scenarios like, should I spend this marketing spend and acquiring these customers, it's important to think of the entire lifetime value. So this customer you'll engage with them right away with the initial purchase, but this person is going to stay around and you're going to be able to interact with them and you have their email, and that's really valuable. And it's a lot cheaper to get people to rebuy than to get people to buy for the first time. So you want to have a holistic view on kind of the lifetime revenue opportunity that exists with acquiring a customer over time. I think that's it. I think that's our last slide.
Yeah. So what we'll do is we'll leave a little space for any Q&A. You guys have any questions, please just fill it in. I will now look at the chat. The session is recorded and we'll be able to share anything to you all. But I think one of the big things that, see the Q&A, I thought it was, I'm also a rookie when it comes down to using this type of technology.
I keep getting excited and standing up and forgetting that my chest is in the camera when I do that. So I'm trying to stay in my seat situated.
I'm in the same boat. So I'm trying to figure out, let's see.
I can read the questions if you want.
Yeah, please go ahead.
Okay. The first one is, what would you consider is the biggest misconception about cash flow?
I think the big thing that people always think, well, at least I'll let Matt answer as well, but for me, it's always that, my sales are going up, but my cash is coming down. The biggest misconception in my mind is that people tend to view their profit and loss as like their holy grail, holy Bible, and everything that is coming from that is like how their business is functioning. So that's a big misconception. So like the timing of cash is, I think, more important than the actual how much profit you make in a month. And so businesses able to self-finance or self-fund themselves through their working capital. I mean, think about it. Working capital, it's a capital that allows you to work, pay bills. That's, to me, the most important. And it's funny how finance and every education we are given is always about cash flow, but when it comes down to how most people manage is on how to optimize for profit loss. So Matt, anything you?
I agree. I agree. It's this dual kind of revenue does not equal cash, and it's just revenue does not equal cash, and the timing of that. And I would say the most applicable situation is when you're showing positive revenue and you're showing positive gross margins and net income is positive and things are great. However, you're buying a bunch of inventory on cash that hasn't gotten to your cost of goods sold yet. So you don't recognize that as an expense, right? Because you haven't sold the inventory yet. So you've got this major cash pull, right? So it's you can look profitable but be cash flow negative. And, you know, working from private equity and venture capital, we see a ton of income statements that look great, and we can't make any decision on investing on the business because we don't know the cash flow.
Yeah.
We just don't know the cash flow. You don't know if the company is really, really making any money, or is over time will kind of grow and be sustainable.
That's a good point. Balance sheet purchases don't hit your P&L, and kind of cash flow is a
Right.
change in a lot of things that happen on your balance sheet. And so most investors look at the free cash flow yield, and free cash flow of a business is what value investors look at, or private equity companies. So those are the kind of things that why it's always the hardest thing is that businesses don't really a lot of times look at that. And I've seen it multiple times in various places, even in my own businesses sometimes.
And it's hard because all these software tools are accounting tools. They're made so that you can tally up for your taxes, and, you know, but in real life, you need a quick way to understand what your cash position is. And there's just hasn't really been, there's not as much of a focus on that, I would say, as far as solutions.
Exactly.
Thank you.
Shocking.
Other question we have is, any tips for designing cash flow forecast for a company that is still in its early stages, pre-revenue stage?
Yeah, I mean, so the tips is, well, I mean, the early stage companies, especially when it comes down to like, you know, you have to have sources of cash. So you either have cash on your balance sheet, or you're expecting revenue in a future state, or you need to get financed. I mean, you know, looking at your business, you have to look at it in a very like non-emotional sense, and not get. So if you're not making any revenue, and you're thinking you're going to make it eventually, you know, you got to think about, first thing I would ask is like, what's your goal? Is it to finance yourself? And so what type of financing? Is it equity financing? And so that requires a certain type of growth, where you have to invest differently. You know, what you're doing with your cash when you invest in an employee, if you think about it, your money that you make as you're putting back into your business you want positive returns on. And so to forecast for a company that's pre-revenue, I would mainly focus on your costs and try to make sure you get all your costs down, and give it a buffer, because you're always going to undershoot a lot of times, and you want to make sure you do it. And then kind of in the other side, the inflows, really think about like what is my realistic timeline, and make that as your baseline, but always do a conservative. Like, what happens if it's 3 months more? What happens if it's 6 months more? And so I think in short, make sure you get your cost down right. And that should be the most, and kind of your cash outflows and the timing of your cash outflows. So understanding that in terms of forecasts, and in terms of revenues, it's more on asking what you want to become. And in terms of that, make sure that if you're like, oh, I'm going to start getting revenue at this date, make that one date to be the variable that you base everything off. So it's going to be 6 months past it or 6 months before it. And you want to make sure you're able to finance yourself to that time.
Yeah, that was, I think, a really good answer. And then the two other things I'd throw in there is, if you're early stage, you're doing what every early stage company is doing, which is kind of testing everything. So if you don't try a marketing channel, then you don't know how it works. You kind of need to be open to like testing things and seeing what works and what messages, and being nimble in that regard. And then also, I would say an early stage business, I would kind of look at the unit economics, like the unit economics of one. I'm not sure if you guys are selling software or product, but I would look at the unit economics of just how much does it take for you to produce one item, and kind of what is the sale price for that, and kind of build off that. And then, you know, you need to think realistically about how much of the market you can capture. So I would do that bottoms up and tops down, like kind of think, okay, we're going to run these campaigns and think we might get this kind of yield, right? But then high level, here's how big the market is. Do we think we can capture 1% of that? Well, if we capture 1% of that, what does our top line look like? And so those, you can kind of approach it those ways and start to zero in on, again, it's not absolute, it's precision without accuracy. You kind of, you can narrow down and start to think about what seems reasonable. Your shorter term is going to be more your marketing driven and performance stuff, and then your longer term is going to be more like market size.
That's the most frustrating part, is that accounting is mathematically, like, you have your ledgers, your debits and credits, and they add up. But finance is an art in a lot of ways, and that's what's really, it's really a science and an art. It's you can make numbers look really good, but you can't take away like fixed costs. So although I think you can make a bunch of scenarios in the top end, but always focus on like, what are the necessary expenses to have your business survive to the point where you think you get financing, investing, or revenue.
And just when I say unit economics, I literally mean, look at how much it costs for you to develop. Forget your overhead. Forget all the overhead people. Just look, how much does it cost for me to produce this one product? And then what can I sell it for? And if you're profitable there, right, then you can start to cover your overhead of your fixed costs. But first, you just kind of strip it out and say, like, does just the activities of me making the product and selling it, is that profitable, right? And then you're kind of taking that, and you've got this whole fixed cost piece that the business runs on, and it's, can you make enough volume on that to cover the cost of those fixed costs to then become profitable? Sorry, I went on a little tangent.
No, great tangents. All right, any other questions? I can't see, Dawa.
Yeah, there's one more. When was the time you made a bad financial decision for your company, and what did you do to fix it?
Oh man, I think marketing is always something where I make a lot of bad decisions, because it's really hard to. It's like the theory is that 50% of your marketing spend typically is just like a sunk cost. I think I made a lot of bad financial decisions in companies. I think the way I fix it is to change my scenarios going forward. So I've become much more conservative. I've become much more thoughtful about budgeting and planning. Even my first business, it was something which I didn't think too much about in terms of being very set in my, you think about your business, and you think, oh, everything will work out, but a lot of times it doesn't happen that way. So just being very, always being open and honest with your own assessment of your business, I think is a big learning for me. But in terms of financial, like a specific like investment decision that we made internally, I mean, hiring too soon sometimes, hiring, that was another thing. So we're big on this whole, bringing people on. I changed the policy where we bring people on and have them as part of our group to really try them out as a contractor. A lot of contract to hires was one way as we scaled a business. Marketing investments. So not making too much brand investment, but very much like changing my perspective on that to being much more about like customer acquisition on like Google. So like being much more methodical on it. I think those are the ways that I've learned a lot more. I think it's more on how I view forecasts, not like learnings from bad decisions on capital investments.
Yeah, mine is just so silly and simple. I mean, I was a part of a failed startup where I was managing, and I had a budget, but I really wanted to build, I made a classic mistake and wanted to build a feature that I didn't really need to. And I didn't have budget, and I had to go get more capital, because I didn't budget fully for having 3 developers instead of 2. And, because I was doing that, we didn't get to I had to go, get more funds, because we didn't get to our MVP. Why? Because we were distracted building 3 features instead of 2. So that was I didn't calculate my runway well, and it was a major problem. And we didn't even end up using the 3rd feature. So yeah, it's like the bad decisions I've made were because I didn't do basic budgeting in an Excel spreadsheet. essentially. It's real. A lot of the things were avoidable.
Yeah. And I think that's why we started our business for the first place, especially Brightflow, is that it takes a lot of time to spend time in Excel sheets all the time. So, you're doing 100 things, taking care of your family, your friend, your company, your life, dealing with pandemics. It's always hard to go back in and reassess your business every week. I think that continual assessment is where the difficulty is. So that's the one place I keep investing more now than I've ever done. Great. I think that's it.
Yeah,
Yeah,
I don't think
that's
we
it.
have any more questions.
All right. Well, thank you all
Yeah,
for
thanks,
joining.
guys.
Appreciate
Yeah, I
it.
just want to say that as Brightflow, we're looking to kind of automate all this, and we think it's an injustice in the world that someone has to like go ask their accountant and wait a week for a result on what a business decision might be. So I would encourage you guys, if you're interested, right now we're working with clients, certainly with our product, but even on a consultative basis. So I would encourage you all to reach out to Robbie and I. We'd be happy to take a look at anything you have and just have a conversation and give you an assessment. And
Totally.
so please feel free to reach out.
Yeah. Thank you so much for that, Matt. Appreciate it. And definitely feel free to reach out. Emails are right here. We're good at responding emails, and just like you guys, we're building our own business. So it's great to get feedback and help others. And that's kind of why we do what we do. Thank you very much. I hope you guys all have a wonderful day.